In this video, I want to talk about why you as a business owner should stay away from revenue-based lending or merchant cash advances as far as you possibly can. I'm Joe Chavarria. Welcome to Cup of Joe. So the premise of starting this this video and talking about this topic is because my company personally went through it, and for context, what I'm talking about here, revenue-based lending, or also known as merchant cash advances if you have a business. This is where the business owner essentially is promising future revenues, and the revenue is based off of revenue alone. So it's not so much credit based, it's not really collateral based, it's not a line of credit, it's not a long-term loan, it's a short-term loan, and it's solely based on the revenue of the business. So for example, if you have a business that is doing $100,000 a year, typically the merchant cash advance lender will give you 10% of your annual revenue, so 10 grand in the form of a loan. It's very short term, again, based on revenue. So all you really would need to provide would be bank statements or credit card processing statements. And essentially you're paying back that loan within a 3 to 6 month period, maybe 3 to 5 month period, very short period. And the issue that I have with this loan, I think it has its place, right? Like if you have no other option, and by getting this loan, you're going to double or triple your revenue in the next 30 to 60 days or 90 days, and you have no other option for capital except this, then it makes sense. You got to do what you got to do. But why I don't think it's a good idea to use it for like working capital or just because is because of the fact that it needs to be paid back so fast, and the interest rates on it are very high. So an example of a $10,000 loan, most lenders will, they're pretty much very equal in terms of how much they charge. Say you borrow 10, most lenders will want a payback around 14 to 15,000 over the course of 3 to 5 months, and most of them want daily payments, Monday through Friday, daily payments, typically payments between like 125 to 200 a day. And I'm over here at the railroad track by my house, but excuse the wind, guys, but why it's a bad idea is because if your business, actually I'm gonna probably walk the other way, less wind, hope that's better. Yeah, so if your business is not a cash flowing business, say that you have like a real estate company and you get certain deposits random times out of the month, this is going to be a cash flow killer. This is really going to kill your revenue because of how fast it has to be paid back, at what interest rates, as well as just really the term. Borrowing 10, paying back 14 to 15 over 3 to 5 months. I mean, that money goes quick. So I think these loans have their place. And as I advise many of my business owners, if you have no other option, your credit's poor, you have no collateral, no 401k, no book of business, no real estate you can collateralize and borrow against, this may be your only option. And if this type of funding will help you seal a deal that it will be very lucrative for your business, whether it's a new account you're bringing on or you're going to spend it in marketing, but not testing marketing, like a marketing play you already know works and gives you a good return, and you're going to double or triple your revenue in the next 30 to 90 days or get very close to it, then okay, I think it has its place for that. But again, if you're looking to use it for working capital or just to have some money in the bank, don't do it. Like it's going to kill your cash flow. So early in the video, I talked about from experience, like when we first started off the business, getting familiarized with business credit and business loans, we took one loan out just like that. And I would say probably 2 weeks into it, regretted it because of how fast it was needing to be paid back, and there really wasn't a lot of leniency with the lender. And so we learned the hard way. Thank God we paid it off, and once it was paid off, it's like never again. But I wanted to share that experience with you all because, these types of lenders are being highly advertised all over the place, and it seems like it's very easy to get funding, and it is. Like, these lenders typically will fund your business checking account within 24 to 48 hours. So it's a very fast funding process. The only issue is it's a cash flow killer, in my opinion. Okay, and so wanted to share this with you just in case you're thinking about it. My recommendation, you may say, great, Joe, it's great you're talking it down, I've been considering it, but what do? I need cash flow. I need money for my business. I would say first seek a credit partner if possible, because credit-based lending is always the most attractive form of lending. So if you have a business, seek a credit partner. See if you have someone, whether they're in your family or a close friend or potential business partner, and see if they have excellent credit, personal credit, and use them as a credit partner in the deal. And basically you leverage their personal credit report, and potentially you can get approved for business credit cards as long as your business has been open for over 2 years, and you can potentially qualify for non-guaranteed or personal credit reported credit cards. Are all going to be business cards only. So I would recommend that, or just flat out holding off on the funding for the time being until you can, just kind of, you may have to turn it down. You may have to say no to the opportunity that you're working on, because while it may be a short-term benefit, you're going to really regret it the moment that type of loan starts tapping into your cash flow and is drafting payments daily, and you're gonna hate it. So I would say maybe turn the deal down. Don't sacrifice short-term or long-term growth and gains for something short-term, right? You may actually really regret that in the long run. And not being biased here, but because I own a credit card company, I would always say, work on your personal credit. It takes a couple months to rebuild, and build some business credit at the same time. So you have two credit profiles being built, and you can leverage both credit profiles, personal and business, to get some credit lines. Like maybe you just need, a $5,000 Amazon trade line. Like you want to buy some computers, buy some electronics, buy some office equipment, and $5,000 would do it. Well, instead of going to get 5 to 10 on a revenue-based loan and paying back, 1.5% of that, why don't you build some business credit? It takes a couple months to build some business credit. Get yourself an Amazon line of credit, a corporate account, and use that line of credit with, and most likely be probably net 60, net 90, but it's not gonna kill your cash flow, and get approved for what you need. So that's just my 2 cents, guys. Thanks for joining in. And if you want to learn a little bit more about this, or you're really thinking about getting some type of business financing, you're not really sure where to begin, you want me to take a look at a deal, or take a look at some financing, or offer some suggestions, or take a look at your personal credit report or business credit report and see what can be done to strengthen it to get approved for attractive financing, I'm happy to do that. Drop me a comment or DM me, and I'm happy to take a look at that. So thanks for joining in on this episode of Cup with Joe, and I'll see you guys later.